Across the country, malpractice insurance rates are starting to creep up little by little. And the reason for this, at least in part, is due to a hardening market. So what exactly is a hard market in malpractice insurance terms? And why does it matter to you? Today, we're going to unpack this topic and give you a simplified definition of a hard market. Plus, give you some tips on how you can navigate it successfully so that you can ensure that you'll stay protected while keeping your rates as low as possible. Stay tuned. Welcome to Malpractice Insights, the show dedicated to helping healthcare professionals understand medical malpractice insurance and providing you with the solutions you need so that you can get back to the work of practicing good medicine. My name is Jennifer Wiggins, CEO of Aegis Malpractice Solutions, and I'm so glad you've joined us today. All right, let's jump in. All industries experience cycles in their business. Times when business is good, and times when business is a little more difficult. This is particularly true of the insurance industry. Throughout history, the malpractice insurance market has experienced many ups and downs, marked by an expansion and a contraction of insurance availability. The way that we often describe these cycles is by calling them either a soft market or a hard market. So let's unpack these a little. A soft market typically looks like this: lower insurance premiums, broader coverage, which means better, more customer-friendly policies, relaxed underwriting criteria, which means underwriting is easier, increased capacity, which means insurance carriers can write more policies and offer higher limits, and more carrier options with increased competition, which keeps your rates down. On the other hand, a hard market typically looks like this: higher insurance premiums, more limited policy options, which means it's not that broad coverage that we saw before, more stringent underwriting criteria, which means underwriting is more difficult, reduced capacity, which means insurance carriers write less insurance policies and they are less willing to offer higher policy limits. And finally, fewer carrier options and less competition among the insurance carriers, which drives your rates up. In times of a soft market, there is generally an active, growing economy with good interest rates. The insurance carriers have abundant capital to insure, and there is low claim activity. But in times of a hardening market, there is usually more economic uncertainty, shrinking capital, increased claim activity, and large catastrophic or major social events. So, when a market begins to harden, insurance carriers basically batten down their hatches and they tighten up their underwriting practices, which can have a real impact on healthcare providers. We're starting to see the beginning stages of a hardening market in the malpractice industry, although right now we're still in the early stages. Rates are starting to go up, but there are still pockets where malpractice premiums are relatively competitive, which shows that the market hasn't shifted completely. So what does this mean for you? As the malpractice insurance market begins to harden, you may or may not experience any immediate changes to your coverage. But what you might see in the coming years is slightly higher premiums and underwriters that are a little bit harder to work with, just meaning that they'll require more documentation for simple changes and they're going to take longer to complete them. And there will be potentially fewer options for you to consider when you're shopping around. When the malpractice market hardens, we usually see a few carriers go out of business. These are typically the smaller carriers, risk retention groups, or other companies who have been struggling financially. And the carriers who are still in the game will stop playing offense and start playing more defense. So, how do you position yourself for success in the future? First, just be aware of what's happening in the market so that you're not caught off guard if you see changes at your next renewal. If you're working with an agent or broker, they can keep you in the loop on what to expect and offer suggestions on how to make changes to your coverage to ensure that you're still protected adequately. Second, shop around smartly. If you start to see your rate go up or experience other changes or limitations in your policy that don't work for you, it might be time for you to look at other options. But be wise about how you do this. We don't recommend that doctors jump ship just because their rate goes up slightly. Understand that you may need to ride the wave a bit and that rates can fluctuate up or down, even in times where the market is soft. Shopping around too often can have disadvantages. Carriers do keep track of how often you inquire with them, and if an underwriter sees that you've approached them for a quote every single year, but you never actually buy from them, it's kind of like the little boy who cried wolf. They don't really consider you a serious buyer, and they may be less willing to offer you a quick, competitively priced quote. In fact, I've seen certain carriers decline even offering a quote to a doctor because they're just not interested in insuring somebody who isn't loyal and who just jumps from carrier to carrier. Also, keep in mind that every time you go to market, it's a lot of work for your agent, and they don't make any more money when they flip you to a new company. In fact, they make less. So you're asking your agent to do a lot of legwork just to move you to a company with a lower price, which means lower commission for them. However, if you do feel that the time is right to look at other options, or your agent recommends that you do so, then it is smart for you to begin working collaboratively with your broker to shop around. Compare your coverage options and rates, and then make a move to a company that you see a better future with going forward. Our agency generally recommends that doctors shop around every 3 years as a best practice. You don't necessarily need to move to a new company every 3 years, but it is important that you gauge the marketplace and keep an eye on what's happening. This is a healthy exercise for all medical practices and individual providers. If you have any questions on this topic, or you want to make sure that you're covered appropriately, click the link in the description box below where you can connect with us via phone, email, or chat today. And if you're listening, please visit us online at aegismalpractice.com. That's AEGIS malpractice.com. By the way, we have our new link that's now live on our website where you can submit your questions to our mailbag for me to answer on air. We'll drop a link in the show notes so that you can submit your inquiries. And who knows, your question might be featured on our next show. And of course, if you haven't done so already, please don't forget to give us a like and a follow. And I'd really love your feedback if you could please leave a review. Your support really does help us to reach more people, and we're so grateful for your clicks and your kind words. This is Jennifer Wiggins. Thanks for joining us.